Hey guys, Omar Khan here from Theta Trading, and today's topic is Mutual Funds 101. What are they and why you may not want them? Before we get on to today's topic, if I could ask you guys a big favor, if you wouldn't mind hitting that like button, help promote our videos to more people who are looking for financial literacy, consider subscribing to the channel if you find the information valuable. I know this would change my life. I knew this stuff earlier on. I hope you guys find it valuable. And let's get on to today's topic, Mutual Funds 101. So what the hell is a mutual fund? Well, simply put, mutual funds are a way for people who don't want to be actively involved in the stock market to participate in the stock market while not having to do it themselves, okay? Now, that all sounds fine and dandy. You say, oh, that sounds like a great idea. But I'm going to show you why it may not be a great idea, okay? So when you invest in a mutual fund, you typically will go to your financial advisor or a stockbroker, and it's geared towards people who want to be hands-off. So if you don't want to be buying and selling this stock and buying this and doing that all day long, because you first of all don't know what you're doing, and secondly, because you don't have the time, well, a mutual fund is an option for you. It's a choice you have, okay? It is really geared towards people who want to be hands-off, not people who want to actively trade like we do here at Theta Trading. It's like, I want to retire in a number of years, and I keep putting $200 or $500 into my account, and it grows, and I don't know what happens with it, and I talk to my guy once a year. That's the typical mutual fund experience. And I'm going to show you why it's so expensive. Like I said, mutual funds are geared towards people who want to be hands-off, and they're done typically through a financial advisor or a stockbroker. You could buy them on your own in your own discount brokerage, perhaps, but most people don't do that. The job of a financial planner is not simply just to buy you mutual funds. It is to actually walk you off the ledge when the markets are doing poorly. So part of their job is psychological, and that is a very important part of the job because people tend to panic at the wrong times, and they tend to get too greedy at the wrong times. They tend to get greedy at the top of the market, and they tend to panic at the bottom market. Financial advisors and stockbrokers are generally pretty good at walking people off the ledge and letting them know their long-term picture, okay? So there is a benefit to having a financial advisor. They might also do some financial planning for you, which is all fine and dandy. Now, what exactly is a mutual fund in terms of how it's managed? Well, a mutual fund is, let's say I put my money in, you put your money in, a bunch of other people put their money in, we all put our money in a mutual fund. Now, a mutual fund may be called XYZ mutual fund. It could be all stocks. It could have some bonds in it. It all depends on what we want. It could be geared towards a certain area, like technology or a certain geographical region. Let's say it's all US or all European stocks. It really depends on what we pick. Now, a job of a financial advisor or let's just go with the financial advisor. The job of the financial advisor is to pick mutual funds on our behalf. A lot of people think their financial advisor actually manages their money. They don't. They just take your money and they give it to a professional to manage. They manage you, okay? And this is a very expensive proposition I'm about to get into, okay? So mutual funds are not, managed by your financial advisor. They give it to somebody else to manage, another company to manage. They manage you. They manage your emotions. They manage you. They may get you to put more money in. That's their job, okay? Now let's look over the costs of mutual funds. Mutual funds can be very expensive. Typical mutual fund, an all-stock mutual fund in Canada, let's say it costs 2.5%, okay? A year, 2.5%. That is known as the MER or management expense ratio. When you're looking at a mutual fund, you want to look at the prospectus, okay? And then look at what the cost of that mutual fund is. So let's take, for example, let's say you had $500,000 in your retirement savings account. And you were invested in a mutual fund which charges an MER of 2.5. You're like, great, I don't know what that means to me, but I'm happy with it. All right, now I'm going to tell you what that means. That means on that $500,000, you are being charged 2.5% a year. That is $12,500 a year that comes out of your account. You don't see it. It comes out of your performance. Now, this money, this fee is charged regardless of whether the mutual fund does badly or poorly. They still get their 2.5%, right? And that I have a problem with. Now, another reason mutual funds don't do so well, and that's why a lot of people started moving towards things called ETFs, like I just talked about, is because of the high costs. When you are a mutual fund, and let's take, for example, the S&P 500. The S&P 500 has 500 stocks in it. That's why it's called the S&P 500. The 500 biggest U.S. companies, okay? Now, those companies are typically held in mutual funds. So the average mutual fund may hold 300 or 400 stocks, which means it looks so much like the market. And when it looks so much like the market, it's going to perform very similar to the market. If the market does 12, it'll probably do a 12. But then you have your 2.5% fee that comes off. So the market may have done 12, but because you hold almost the same stocks as the market, you're performing at 12%, and then you take off that fee of 2.5%, and now you are at 9.5%. And I want to point you to the CNBC article. It shows here. Take a look at this article here, guys. New report finds that almost 80% of active fund managers are falling behind major indexes. I want to take you and just take a look at the last line, couple lines here, the last paragraph here. It says it's hard to outperform on ETF Edge. It costs more for active managers when they're trying to compete with the S&P 500 that is essentially free through an ETF wrapper. So what that means, it's very difficult for mutual funds to perform better than if you just buy an ETF because of those fees, right? When you look like the market, you almost hold the same stocks as the market, and you have a performance fee of 2.5% or management fee of 2.5%, you are typically going to underperform. And this shows you that 80% have underperformed. So you're just better off buying an ETF. Now that is something that people don't know. What these companies are, these mutual fund companies, think of your big banks, your big mutual fund companies, they're not great at managing money. Look at it, 80% of them don't even beat the stock market. What they're really good at is marketing. You're richer than you think. You have more money than you know. Well, come and make your dreams come true. This is what they do. They're marketing. They are marketing geniuses, but they are not great at performance. So in the last few years, a lot of people have been catching on to this and been moving something called ETFs. And you can invest in an ETF for a fraction of the price, like I said. And that's why you've seen a big rise in ETFs. So people have said, I don't want mutual funds anymore. I want to invest my money in exchange-traded funds. It's the same way for me to participate in the stock market, but I'm doing it now at a fraction of the cost. Okay? And that is where we are headed. Now that we've gone over mutual funds and why they may stink. Okay? Now, again, think about it. You're going to perform just like the market most often. Now, if you're looking for a mutual fund that's different, look for ones that don't have 300 or 400 holdings. Look for ones that are concentrated, meaning, let's say, less than 25 holdings. Those ones have a good chance of beating the market because they look different than the market. So if they're taking an outside bet on a company, you're like, you know what, I think these companies will do well. I don't want to look like the market. I want to look different than the market. Well, then you've got a pretty good chance to beat the market. And you can justify that management expense ratio, that MER, those fees. But when you look just like the market and you are not able to perform like the market, to me, that's a complete waste of money. Now, what do we do here at Theta Trading is we manage our money ourselves. So we don't take the mutual fund approach. We sell puts, which means we agree to buy our favorite stocks for cheaper than they're trading for. If you want to know what that's about, watch one of my videos on naked puts and covered calls. The concepts are crazy. It changed my life. Now, that's what we do here at Theta Trading. We buy and sell options on companies we want to own. So, for example, if Apple's trading at $160, and I say to myself, you know what, I'd like to buy Apple at $155. Well, as long as I guarantee that buy price, I get paid a lot of money for it. So we are something very different than mutual fund. We show people how to manage their money themselves. If this sounds like something that appeals to you, appeals to your logic, where you can agree to buy your favorite companies and get paid a lot of money for it, click on the link below and try to book a call with us. We'll explain what we do here. We'll explain why we believe this is the best investment strategy out there, the Theta strategy. It changed my life. I think it'll change your life if you give it the opportunity, if you give it the time. And like I said, you don't want to be investing in mutual funds long term, in my opinion, that look like the market, because over a long period of time, that $12,500 that you're paying on a $500,000 retirement account over the course of 20 years, that is a lot of money, guys, which you can easily avoid either A, by going through ETFs, or B, two, you can just directly invest in an ETF. This will take all those fees away, and I think it will give you better performance. Like I said, the last thing I want to leave you with, guys, if you're looking for mutual funds, you don't want to be part of managing your own money. Like I said, look for funds that have a few holdings, that have something, that stand for something. Let's say it's a technology mutual fund and it only has 15 or 20 holdings. Well, there's a decent chance that may beat the index. You want to look for things like that if you are so inclined. Now, that's not meant to be advice. I'm just simply sharing my experience. I found the mutual funds that typically have beaten the markets are the ones that are concentrated, that stand for something, that are not like the market. Guys, I hope you guys enjoyed this explanation of mutual funds and why they're so damn expensive. I hope you guys found it valuable. Until next time, Omar Khan here from Theta Trading, and we'll talk soon. Take care, guys.